Hello everyone, and welcome back to the last section in our Trading Tools module. Today, we're going to be talking about yet another tool that you can use to add confluence to your trading setups. Throughout this module, you've heard that word a lot, confluence. I want to reiterate that all of the tools in this module are just additional points of information. Sure, some of them can be standalone systems like the Ichimoku Kinko Hyo. But more often than not, all of these tools should be used to confirm your trading bias and therefore increase the chance of a favorable trading outcome. Remember, if none of these tools speak to you, then don't use them. It's as simple as that. Whenever you add information to your chart, it should be done in a way that helps your trading, not hinders it. With that said, let's dive right into oscillators. Oscillators are technical indicators that oscillate between two extreme values. Oscillate is just a fancy term to describe back and forth movement. They usually consist of upper and lower bounds with a centerline or midpoint. Depending on the oscillator's position in relation to price, we can use these tools as a way to help identify potential exhaustion points. If price has gone on a strong uptrend and an oscillator has been hovering in the upper bound of the range, we might consider that asset to be called overbought. This indication alone doesn't provide us a trade setup, but we might be more cautious to enter new long positions if the oscillator is warning us the trend might need a breather. Conversely, if price has been consistently falling off like a brick and an oscillator has been hanging out in the lower bound of the range, we might consider that asset to be oversold. This could mean that sellers are getting exhausted and it might be time for opportunistic buyers to step right in. I just want to note that there are many kinds of oscillators that can be found in your favorite charting software's library. Relative Strength Index, also known as RSI, Moving Average Convergence Divergence, also known as MACD for short, stochastics, etc. There are pros and cons to each one, but today's lesson won't get into which ones you can and should use, because we already know the answer, right? It always depends. Ultimately, oscillators help paint a clearer picture of that ongoing conversation between buyers and sellers. When one party gets too aggressive and hammers the market day after day, it can only go on for so long before a temporary shift in control is bound to happen. The key takeaway here should be that oscillators provide an additional point of confluence that help confirm our trading bias. Now, the last thing I do want to touch on are divergences, or divs for short. Divergences, by definition, are an additional point of information that we can glean from using oscillators. When an oscillator diverges from price action, it's a clear indication that something's going on in the background. The most important thing to remember with divergences is that they act as potential leading indicators for price. With that said, let's move on and look at the two types of divergences. First, let's talk about regular divergences, or regular divs. Regular divs are usually found at the top or bottom of a trend and warn us that a trend may be coming to an end. A regular bullish divergence forms when price makes a lower low, but the oscillator makes a higher low. This nuanced discrepancy tells us that there is weakness from the sellers. This signals potential seller exhaustion and potentially a trend reversal. You'll usually find this type of divergence at the bottom of a trend, not the top. On the other hand, a regular bearish divergence occurs when price makes a higher high, but the oscillator makes a lower high. This tells us that there is weakness from the buyers. This signals potential buyer exhaustion and a possible trend reversal. You'll usually find this type of divergence at the top of a trend, not the bottom. Now that we know the rules for regular divs, let's look at an example of each. Here we have two regular divergences. Can you guess which is which? If you guessed that the left one is a bullish divergence, you are correct. Do you understand why? Here we have price making a lower low, while the oscillator is making a higher low. This divergence between the price and the oscillator tells us that there is some seller exhaustion present. Sellers are being overly aggressive and running out of steam to keep hammering the bids. On the flip side, this example on the right is a clear bearish divergence. We see it happened at the top of the trend. Price made a higher high while the oscillator made a lower high. This divergence between the two warned us that buyers were drying up. There were no more of them present to push the price up higher, and it eventually gave way to selling pressure as we hit a local top. The key takeaway here is that regular divergences signal a potential trend reversal. Now let's switch gears and talk about the other kind of divs. Hidden divergences. Hidden divergences, or hidden divs, are unique because they provide us opportunities to re-enter the market in the direction of the trend. Instead of signaling potential trend reversals, hidden divs signal trend continuation. You'll usually find them during retracements in an uptrend or a downtrend. Now, a hidden bullish div occurs when price makes a higher low, but the oscillator makes a lower low. This provides buyers with an opportunity to re-enter a long position on a higher low. You can liken this to buying the dip, so to speak. On the other hand, hidden bearish divergences occur when price makes a lower high, but the oscillator makes a higher high. This is equivalent to selling the rallies, as it showcases underlying strength on the seller's part. Sellers have covered their shorts lower and are ready to jump back in and continue the downtrend with their selling. Now let's take a look at what these hidden divs look like. Over here on the left, we see a hidden bullish divergence. Price made a higher low while the oscillator made a lower low. Here we saw buyers stepping in to continue the uptrend. Now, over on the right, we see a hidden bearish divergence. Price made a lower high while the oscillator made a higher high. This provided the sellers a great opportunity to sell the bounce and jump back into the market. Now that we know what both regular and hidden divergences are, I want to take things a step further and break down some of the rules for identifying and subsequently trading divergences. The first set of rules I want to point out are technical ones. Divergences only exist if there's one of the following conditions: a high higher than the previous high, a low that's lower than the previous low, or double tops or bottoms. When identifying divergences, you need to connect tops to tops or bottoms to bottoms. The key is to be consistent. If you're looking for bullish divergences, you will be looking at bottoms or lows. If you're looking for bearish divergences, you'll be looking at tops or highs. It's essential that the slope of the connected line must differ. The next rule to remember is that divergences only play out after they've crossed back from the upper or lower bounds, back into the range, or through the center line. Yes, divergences can build and build over multiple sessions until playing out in the price action. A good strategy is to set alerts on the oscillator for when it crosses from oversold or overbought back into the median range. Now, make sure to use common sense when identifying divergences. Don't look for hidden bearish divs in an uptrend. The likelihood of low time frame bearish continuation in a larger macro uptrend is arguably small and definitely not worth trading. I'll reiterate another tip we've touched on in past modules. The trend is your friend. Use divergences to help add confluence to your trades. I never recommend trading divergences alone. They should be used as additional points of information that help confirm our trading biases. Lastly, remember that divergences are leading indicators. Just because we observe a divergence forming, it does not guarantee that a trend reversal or trend continuation is bound to happen. Let price action and other tools such as volume help guide your analysis and ultimately your trade execution. Thanks for watching, and I'll see you soon.